The market is cheering at all-time highs, but the foundation is rotting. America is sitting on $38 trillion in debt, adding $1 trillion every 100 days, while paying over $1.1 trillion a year just in interest. Since 2020, more than 40% of all US dollars ever created have been printed, inflating stocks, housing, crypto, and AI into one massive, unstable bubble. This isn't growth, it's dilution. In 2008, one sector collapsed. Today, the mechanism that prices every asset is under strain. When confidence breaks, it won't crack slowly. It will snap everywhere all at once. In 2008, the system didn't fail because people were reckless. It failed because the math stopped working. Housing prices had detached from incomes, leverage had exploded, and trillions of dollars in mortgages were built on borrowers who could not service them once teaser rates reset. Default rates made collapse statistically inevitable, not hypothetical. When liquidity vanished, balance sheets imploded in days, not years. The credit system froze, trade halted, and governments faced a binary choice: allow a full liquidation or intervene at unprecedented scale. They intervened. Trillions were created to stabilize banks, guarantee liabilities, and restart lending. Interest rates were forced to zero. Central bank balance sheets expanded from under $1 trillion to multiple trillions in a short window. The immediate crisis stopped. Markets recovered. Confidence returned. But the cost of that rescue was not paid in 2009. It was deferred. That decision rewired the entire financial system. The post-2008 world trained markets to expect rescue. Risk was no longer priced for failure. It was priced for intervention. Asset prices learned a new rule: drawdowns would be met with liquidity. Debt became cheaper than discipline. Leverage became rational behavior. Growth was no longer required to justify valuations. Access to funding was. This wasn't an accident, it was policy. What followed was a structural shift, not a recovery. Rates stayed near zero for over a decade. Debt piled up because servicing it was easy. Governments ran deficits without immediate consequence. Corporations refinanced endlessly. Speculation flourished because the penalty for being wrong had been softened. By the time the next shock arrived, the system was no longer resilient. It was dependent. That next shock came in 2020, and the response dwarfed 2008. Over $6 trillion in stimulus and support programs were deployed. Roughly 1/4 of all US dollars in existence were created in just a few years. Balance sheets exploded again, this time past $7 trillion. Markets didn't just recover, they detached entirely from underlying cash flows. The lesson absorbed by participants was clear: liquidity would always arrive faster than consequences. This is the critical bridge to what exists now. The problem today is not that markets are irrational. It's that they are correctly responding to incentives created after 2008. When capital is abundant, borrowing is rewarded, and downside is socialized, prices must rise across everything that can absorb excess liquidity. That is not optimism, it's mechanics. So 2008 was not the disaster, it was the rehearsal. It taught policymakers how to suppress pain, taught markets how to front-run rescue, and taught debt that it could grow faster than the economy without immediate punishment. The system survived by changing its rules. And by doing so, it guaranteed that the next failure would not be isolated to one corner of finance, but embedded everywhere at once. What followed the post-2008 rescue was not a normal expansion. It was a distortion that spread outward through the entire system. Once rates were pinned near zero and liquidity became permanent, capital stopped discriminating. It didn't flow toward productivity first. It flowed toward anything that could absorb excess money. That is how you end up with stocks, housing, bonds, crypto, venture capital, collectibles, and speculative technology all inflating at the same time. Not because they share fundamentals, but because they share one engine. That engine is liquidity. When borrowing costs sit below nominal growth and cash yields trail inflation, holding money becomes a guaranteed loss. Capital is forced to move. It doesn't ask whether valuations make sense. It asks where it can escape dilution. This is why asset inflation today is synchronized. It is not optimism. It is defensive behavior against currency erosion. Look at the alignment. Equities at record valuations while earnings growth slows. Home prices still roughly 40 to 45% above pre-2020 levels, despite the fastest rate hiking cycle in decades. Crypto markets swelling back toward $3 trillion without corresponding real-world adoption gains. Venture and AI funding reaching hundreds of billions, while cash flow remains hypothetical. Even non-productive assets, art, collectibles, luxury goods, have surged because scarcity itself became a trade. These are not separate bubbles. They are expressions of the same pressure. When liquidity is abundant, prices rise everywhere it can land. When leverage is cheap, speculation becomes rational. Margin debt crossing $1 trillion is not reckless enthusiasm. It is a logical response to a system that rewards borrowing more than saving. If capital costs 6 to 7% and asset prices rise faster than that, leverage is incentivized by design. This is where the illusion becomes dangerous. Many believe asset prices are rising because value is being created. In reality, prices are rising because the unit of measurement is weakening. When the money supply expands faster than the production of goods and services, prices must adjust upward. That adjustment shows up first in financial assets because they are liquid, tradable, and instantly repriced. This also explains the widening disconnect between markets and lived reality. The top slice of households that own the majority of assets see balance sheets expand. Everyone else faces higher costs. Wages lag while shelter, food, insurance, and energy reprice upward. This is not a coincidence or a failure of policy execution. It is the expected outcome of sustained monetary expansion. Here is the critical link forward. Systems built on a single engine fail together when that engine stalls. Because all major asset classes are being levitated by the same force, they are now correlated at the point of failure, not diversification. When liquidity tightens or confidence fractures, there is no safe internal rotation. Capital doesn't move from one bubble to another. It rushes for exits simultaneously. This is why what comes next cannot resemble past cycles. In prior downturns, weakness was isolated. Today, inflation has synchronized risk. And once the engine that inflated everything begins to reverse, everything feels the gravity at the same time. The engine that inflated everything runs on one unavoidable constraint. Debt obeys math. Liquidity can distort prices for a while, but debt compounds relentlessly. And once compounding outruns income, the system stops being flexible and becomes brittle. That is the point the economy has now reached. Since 2020, the US money supply expanded by over 40%, the fastest surge in modern history. At the same time, federal debt surged past $38 trillion, increasing by roughly $1 trillion every 100 days. This would already be destabilizing on its own. But the real danger appears when interest costs accelerate faster than the economy's ability to absorb them. That threshold has now been crossed. Annual interest payments have moved above $1.1 trillion, making them one of the largest line items in the federal budget. Every single percentage point increase in average borrowing costs adds roughly $350 to $400 billion more per year, without funding a single service, program, or investment. This is not spending, it is friction. And friction compounds. This is the debt flywheel. New borrowing increases interest expense. Rising interest expense forces even more borrowing. More borrowing increases supply, which demands higher yields, which raises interest expense again. Each rotation accelerates the next. The flywheel does not pause, negotiate, or respond to optimism. It responds only to arithmetic. The critical inflection point is when debt grows faster than the income required to service it. US debt to GDP now sits around 122%, a level historically associated with instability, restructuring, or currency debasement. At this scale, growth no longer fixes the problem unless it is extraordinary and sustained. Moderate growth simply slows the rate of deterioration. It does not reverse it. This is where monetary policy loses freedom. In earlier eras, central banks could raise rates to cool excesses or cut rates to stabilize downturns. That flexibility depended on manageable debt levels. Today, rate increases strain solvency. Rate cuts fuel further inflation and speculation. The policy lever still exists, but it no longer produces neutral outcomes. Every move now carries systemic consequences. This is why confidence becomes the hidden variable. Debt is tolerated as long as markets believe it can be rolled over indefinitely. Once doubt enters, once lenders question whether future income can realistically cover future obligations, the cost of borrowing rises sharply, not gradually, abruptly. Compounding works in reverse, too. This links directly back to the inflated asset landscape. The same liquidity that drove prices upward also masks the growing structural imbalance beneath them. But liquidity does not eliminate debt. It accelerates its accumulation. The longer suppression lasts, the larger the imbalance becomes and the smaller the margin for error. The danger is not a recession. The danger is loss of control. When interest costs consume an expanding share of national income, policy stops being proactive and becomes reactive. Choices narrow, options vanish. At that point, markets no longer debate valuations or growth prospects. They price one question only: can this system keep financing itself without breaking the currency? Once that question dominates, the flywheel doesn't slow, it snaps. Once debt reaches this scale, monetary policy stops being a steering wheel and becomes a trap. The central bank no longer operates in a neutral environment where it can fine-tune growth and inflation. It is forced into fiscal dominance, a condition where government debt dictates policy outcomes, not economic theory. Here is the constraint. With roughly $38 trillion in outstanding federal debt, the sensitivity to interest rates is extreme. Every sustained move higher in yields translates into hundreds of billions in additional annual interest costs. Those costs do not disappear. They must be financed with new borrowing. That borrowing increases supply. Increased supply demands higher yields. The loop tightens. This is the point where policy options collapse into contradictions. If rates are raised to cool speculation and contain inflation, the government's debt service burden explodes. Interest expense, already above $1.1 trillion per year, accelerates rapidly. Treasury issuance rises just to cover interest, crowding out private credit and draining liquidity from the broader economy. What begins as tightening becomes solvency stress. Defaults rise, markets seize. The very act of fighting excess destabilizes the system. If rates are cut to ease that pressure, the opposite failure emerges. Cheaper credit reignites speculation, weakens the currency, and drives capital back into already inflated assets. Inflation risks reaccelerate. Real yields sink. Confidence in the purchasing power of money erodes. The bubbles that were supposed to be deflated expand further, making the eventual correction larger and more violent. This is the no-win choice. Tightening creates defaults. Easing creates debasement. Both paths feed instability. The reason this matters now, rather than at any other point in modern history, is scale. Previous cycles operated with far lower debt loads relative to income. Policy mistakes were survivable. Today, the margin for error is thin because the debt structure itself magnifies every decision. Monetary tools still exist, but their side effects now outweigh their benefits. This is why markets have become hypersensitive to policy signals. Every word from the central bank is interpreted not as guidance, but as a referendum on credibility. Investors are no longer asking whether rates will move. They are asking whether the system can withstand those moves. That subtle shift is dangerous. Once participants believe policy is constrained by debt rather than economics, confidence becomes fragile. This links directly back to the debt flywheel. Fiscal dominance is what happens when compounding interest outruns policy control. The flywheel does not stop because leaders want stability. It stops only when financing fails or confidence breaks. Until then, the system oscillates between inflationary pressure and deflationary stress, never resolving either. At this stage, the central bank is not choosing outcomes, it is choosing which failure arrives first. That is the defining condition of fiscal dominance. And once a system reaches it, timing stops being gradual and becomes abrupt. Markets do not wait for perfect clarity. They move the moment belief cracks. That is why the next question is not whether this imbalance exists, it does. The question is when confidence finally gives way. Fiscal dominance sets the trap. Confidence is what triggers it. Markets do not collapse because a spreadsheet crosses a threshold. They collapse when participants collectively decide that the system's promises can no longer be trusted. At that moment, pricing stops being about valuation and becomes about survival. Modern markets are not driven by belief in growth alone. They are driven by belief in continuous refinancing. Governments roll debt, banks roll funding, corporations roll maturities. The entire structure depends on the assumption that tomorrow's buyers will always exist. As long as that assumption holds, even extreme imbalances can persist. When it weakens, everything reprices at once. This is why collapse does not begin with headlines about recessions. It begins quietly in funding conditions. Small cracks appear where confidence is most sensitive. Demand for new debt, collateral quality, and the willingness to hold risk without immediate compensation. These are not emotional signals, they are mechanical. Look at where stress emerges first. Credit spreads widen before equities fall. Short-term funding becomes selective. Liquidity pools thin. Lenders demand higher premiums not because they want better returns, but because they want protection against non-payment. When protection becomes the priority, risk assets are no longer priced for upside. They are priced for exit. This process accelerates because leverage is embedded everywhere. Margin debt has climbed toward record territory near $1 trillion, amplifying forced selling when prices fall. Structured credit depends on stable collateral values. Commercial real estate delinquencies have already moved into historically dangerous territory, exceeding prior crisis benchmarks in some segments. These pressures don't cause collapse on their own, but they weaken the confidence floor. Here's the critical link forward. Confidence is binary. It does not erode smoothly, it holds until it doesn't. When participants believe refinancing will fail or currency purchasing power will erode faster than yields compensate, behavior shifts instantly. Buyers step back, sellers rush forward. Liquidity evaporates not because money disappears, but because no one wants to be last. At this stage, price discovery turns violent. Assets that were never meant to be sold quickly are dumped simultaneously. Correlations snap toward one. Diversification fails because everyone needs cash at the same time. What looked like stability becomes fragility in hours. This is why the belief that the Fed will step in is no longer a stabilizer. Under fiscal dominance, intervention itself can undermine confidence by signaling desperation or currency risk. When policy tools are constrained, reassurance loses power. Markets sense that reality before official statements ever catch up. Confidence is the invisible load-bearing wall of the system. When it fractures, the damage spreads far beyond finance. Credit freezes ripple into hiring, trade, housing, and consumption. This is not panic. It is rational withdrawal. And once confidence breaks, the sequence that follows is no longer discretionary. The only remaining question is where the break begins, because when belief goes, the unwind is immediate, indiscriminate, and unforgiving. Once confidence becomes fragile, timing stops being abstract. It becomes mechanical. The clock is not set by market sentiment or headlines. It is set by the government's need to refinance itself continuously, at scale, without interruption. This is where instability turns into a deadline. The U.S. Treasury now operates on a rolling funding treadmill, roughly $50 billion in new borrowing every single week, not to invest or expand capacity, but to cover deficits and service existing obligations. Over the past 18 months alone, issuance has totaled roughly $2.5 trillion, and the pace is accelerating. Current projections put annual borrowing near $2.9 trillion, the largest peacetime financing requirement in history. That scale matters because buyers are not infinite. For a time, excess liquidity masked the strain. Trillions sat in money market funds, earning modest yields while waiting for opportunity. That pool absorbed massive issuance without immediate disruption. But that reservoir is no longer expanding. It is being drawn down. And once marginal buyers are exhausted, the system must compete harder for capital. This creates the liquidity tug-of-war. To attract sufficient demand, Treasury yields must rise. Higher yields pull capital out of other assets, equities, credit, real estate, tightening financial conditions. But higher yields also worsen the government's own interest burden, forcing even more issuance. The system is effectively bidding against itself for the same dollar. Each attempt to stabilize funding tightens pressure elsewhere. This is why timing compresses. The market does not wait for insolvency. It reacts to strain at the margin. A single weak auction, a sudden spike in required yields, or declining bid-to-cover ratios can signal that demand is no longer automatic. That signal doesn't need to persist for months. It only needs to appear convincingly once. The danger zone emerges when new debt can only be sold by draining liquidity from functioning parts of the economy. At that point, stability becomes self-defeating. Every successful auction worsens conditions elsewhere. Every attempt to normalize policy accelerates stress. The machine continues running, but it begins to eat itself. This is the bridge between confidence and collapse. Markets can tolerate bad news. They cannot tolerate funding uncertainty. Once participants suspect that future issuance will require materially higher compensation or direct monetary intervention, the perception of risk changes instantly. Capital becomes defensive. Duration shortens. Optionality is prized over return. Timing is therefore not about prediction. It is about pressure accumulation. When refinancing needs grow faster than the system's ability to absorb them without distortion, the window narrows. And when that window closes, it closes suddenly. This sets the stage for the final turn. Once the Treasury wall meets exhausted liquidity, the trigger is no longer theoretical. It becomes situational. The next stress event doesn't need to be large. It only needs to arrive at the wrong moment. When demand is thin, confidence is conditional, and the margin for error is gone. When pressure reaches this level, collapse does not arrive gradually. It arrives through a snap, a single break that cascades across every interconnected market. The system is already stretched. What matters now is which stress point gives way first. There are 3 primary failure paths, and any one of them is sufficient to trigger a full reset. The first is a Treasury market fracture. This does not require a dramatic failure or empty auction. It only requires insufficient demand at acceptable yields. When buyers hesitate unless compensated with sharply higher rates, the signal is unmistakable. Trust in long-term repayment is weakening. Even a modest deterioration in bid-to-cover ratios or sudden yield spikes forces repricing everywhere else. With nearly $3 trillion in annual issuance, even small disruptions propagate instantly. Once investors suspect that debt must be monetized to clear, confidence in the currency itself comes into question. The second is a funding and credit seizure. Modern finance depends on short-term lending markets to roll obligations daily. If collateral quality is questioned or haircuts rise, liquidity can vanish in hours. Repo markets freeze. Credit spreads explode. Institutions sell whatever they can, not what they want to. With leverage embedded across balance sheets, forced liquidation becomes self-reinforcing. This is how functioning markets turn disorderly before most participants even understand what's happening. The third is inflation reacceleration into economic weakness. If prices surge again while growth stalls, policymakers are cornered. Tightening into fragility triggers defaults. Easing reignites currency debasement and asset inflation. Either choice shatters confidence. At that point, inflation is no longer a cost of living issue. It becomes a solvency event. Debt that cannot be refinanced at tolerable rates must be restructured, explicitly or implicitly. What unites these paths is speed. The system does not step down gradually because leverage removes friction on the way up and adds violence on the way down. Correlations converge. Diversification fails. Markets that were liquid yesterday gap lower tomorrow. The reset is not announced. It is discovered in price action. This is the final link in the chain. The Treasury wall, policy constraint, and confidence fragility all funnel toward one reality. The unwind happens where financing fails first. Once that happens, the question is no longer whether intervention is possible. It is whether intervention itself accelerates the loss of trust. And when trust breaks at the sovereign level, there is no circuit breaker. There is only repricing, fast, brutal, and everywhere at once. Once the snap occurs, the damage does not remain contained. It propagates outward through a chain reaction that hits finance first, then the real economy, then society itself. This is where instability stops being theoretical and becomes unavoidable. The initial shock forces asset repricing. Equity valuations compress. Credit spreads widen violently. Highly leveraged positions unwind under margin pressure. What looked liquid at scale becomes illiquid instantly. Pension funds, insurers, banks, and corporations all react at once, not to seek opportunity but to preserve solvency. Capital expenditure freezes. Hiring stalls, risk tolerance collapses. From there, the feedback loop accelerates. Falling asset prices reduce collateral values, tightening credit further. Businesses dependent on refinancing face higher costs or no access at all. Layoffs rise, tax receipts fall. At the same time, government borrowing needs increase to stabilize unemployment, banks, and markets. This forces even more debt issuance into an already strained system. The flywheel spins faster, not slower. This is why 2026 becomes the danger zone. Debt servicing costs are compounding into a fiscal calendar that cannot be postponed forever. With national debt already near $38 trillion and interest expense on track to exceed $1.2 to $1.3 trillion annually, the margin for absorption disappears. Each rollover cycle becomes riskier. Each auction carries more weight. The system begins to live auction to auction, decision to decision. As pressure intensifies, policy loses credibility. Emergency measures no longer reassure, they signal panic. Currency weakness becomes visible. Inflation expectations rise even as growth contracts. Social tension escalates as living costs rise and asset losses spread beyond investors into pensions, housing, and employment. This is not a recession. It is a confidence collapse layered on top of a debt crisis. At this stage, choices narrow to restructuring, stealth debasement, or outright default in real terms. None of these paths preserve purchasing power. None protect the unprepared. The reset becomes unavoidable because the system can no longer roll forward its promises without breaking them. This is why the next downturn cannot resemble 2008. That crisis was absorbed by balance sheets that still had room to expand. This one arrives when expansion itself is the problem. The shock does not clear excess, it exposes it. And when the chain reaction completes, it will not feel like a market cycle ending. It will feel like the price of money resetting. Because when debt, confidence, and time collide, the system doesn't bend, it breaks.